Is the Canadian real estate market crashing? And if it is crashing, how low will it go? And then what happens next? Well, in this video, we're gonna look at a Better Dwelling report where BMO answers a lot of those questions. BMO is the Bank of Montreal, and they're gonna talk about what they see is happening in the marketplace, what's happened historically, and what will happen if it does go down as much as they expect. And make sure you stay until the end because they actually say exactly what needs to happen in order for the market to get back to a place of affordability where there's much more activity. So let's get to it. Hi everybody, my name is Connie Sarvananthan. I'm a real estate agent and active investor here in Toronto and the GTA. In this Better Dwelling report, it really covers off both what's happening now and what BMO thinks is going to happen in the future. So let's get right to the report. Okay, so this is the Better Dwelling report. It is how much will Canadian real estate crash? Stability requires a big correction according to BMO, which is the Bank of Montreal. So in the first paragraph, it basically says Better Dwelling is saying, the real estate bubble is starting to unwind. And so everybody wants to know how low will it go? And BMO Capital Markets had a meeting with their clients and they started talking about this, which is what this article is about. And basically saying that the rising interest rates are certain to cause a correction as it purges excess leverage. So what does that mean? That means that the interest rates were so low that as a result, there was excess leverage. So leverage could mean that people were buying homes that they normally wouldn't buy at excessive prices because the interest rates were low, but Canadians were using that leverage across the board, whether they were, increasing their lines of credit on their existing homes or they were, buying cars, whatever the case may be. The interest rates were so low, people were definitely leveraging that. So they're saying by raising the interest rates, some of that excess will be taken away. The other thing is that prices need to drop significantly to accommodate some of those higher interest rates. And how long this will take to recover? Well, the last time that we had a crash in the 80s, it took almost 15 years is what they're saying. And so what I would say about that is in the 80s, we had our worst real estate crash ever. And it did take, between 10 and 15 years to recover, depending on where you were. And so if you bought a house, even if you bought it at the peak of the market, if you're planning on staying there for the long run, from 10 to 15 years, even the worst crash we've ever had, it did recover by then. So I know that's not necessarily the most comforting thing, but it is something to think about because, even though our worst crash, we recovered. So housing long-term has always proven to be okay. You just may need to wait it out. So what's next on this report? Okay, so next, the article says Canadian real estate prices historically have always corrected to fundamentals. So what does that mean? So BMO has found that Canadian home prices have increased about 3% per year since the 1980s. And that 3% kind of reflected inflation and real wage growth and falling interest rates. Now, they do say that the majority of that was due to the interest rates, but the 3% was where it was. And typically what happens in a normal market, according to BMO, is that people are going to pay what makes sense. When people don't pay what makes sense is where you get a bubble. So that's what BMO is saying. So, and the reason why is when people in a bubble, people don't pay what makes sense because they start to leverage themselves beyond what makes sense. So they say in a regular market, lower interest rates mean that you actually increase your affordability because you're paying less interest on you're paying less interest, so you don't have to pay as much on your interest payments, so you can increase your principal payments and pay down your mortgage. But what was actually happening is that instead of doing that, people were taking the lower interest rates and actually increasing their budgets to afford more. So that's why they're saying this allows buyers to more easily absorb price hikes and rising prices even faster. And the Bank of Canada has also pointed this out, which is why interest rates have been rising. So they've already done 2 price hikes this year. Another one is happening at the beginning of June, and they may do another one yet. So definitely a policy for the Bank of Canada. And then the last thing that they're saying is, with interest rates hikes and trying to quash inflation, they definitely feel like a correction is coming. What they don't know is how big is that correction, where is that correction going to happen, and how long is that correction going to take. So let's look at the next step. Okay, so next up, Canadian real estate is 38% overvalued and needs a big drop just to accommodate rates. So one of the things that this article says is that the gains that have happened in real estate, a third of a property's value has happened in the last 2 years. So what does that mean? So it's saying that if a house is worth $900,000, $300,000 of that, a third, happened in the last 2 years. And I actually know that's true in some markets. So for example, I have some clients that are looking at townhomes in Whitby, and 2 years ago, those townhomes were $600,000, and now those townhomes are selling for $900,000. So because of markets like that, what they're saying is that the Canadian real estate market is overvalued by 38%. Now, they're also clearly saying that doesn't mean a 38% correction is coming, but the overvaluation is steeper and it is stretching affordability like they've never seen. So this is a trending of 40 years, and they use Vancouver, British Columbia. So the black line is the trend, and the blue line is the actual prices, and they start in the 80s and they go all the way up to 2022. So what you'll see is the 80s, the pricing was higher, and then it peaked in the right before the crash, and then it went down, and then it was lower for a while, and then it dropped in 07, 08, and then it came back up, and then it was normal. Then it peaked again in 2017, dropped again, and then this is the big bump that they're saying that went up 38% that they hadn't seen before. So that's what they're talking about. So the other thing that they're saying is higher interest rates almost always how housing bubbles purge excess price gains. After leaving the policy too loose for too long, they've already seen a 75% basis point gain this year, and they're expecting another 125 basis point gain. So what does that mean? That means for home buyers, home buyers are going from mortgages that were, at 1.5% to now being between 3.75% and 5.5%. So they're feeling like it can definitely stall growth. But they're also saying stalling growth is fine, but prices actually need to drop 10 to 20% to maintain the current affordability that we had before the run-up in the last 2 years. And the other thing that they're saying is this higher financing cost will also be a challenge for investors, because there was a lot of investors in the market in the last 2 years. Because again, investing in housing was better than investing in the stock market because you were getting quicker, faster gains in the last 2 years. So with investors now, if they are now paying higher costs, and especially when they're landlords and they're you can't pass on those costs, then it's going to become a challenge. For example, in Toronto and Ontario for that matter, when a tenant signs a lease, they are locked into their price. And to raise that price beyond, like this year, it was 1.2% is the annual increase. That's it. You can't raise it significantly, even if your costs go up. And if you do want to do that, there's a whole process to try and do that. And it's not an easy process to do. So for that, again, prices would need to fall to keep investors involved in the marketplace and to be as active in the marketplace. So that's that section. So let's look at the final section. Okay, so the last part of this article is really about what's going to happen and how long it'll take to recover. So first of all, they're saying that corrections don't have any sort of set timeline for how they're going to happen or how they're going to recover. They have found that previous corrections have taken 2 to 15 years. So I've talked about this before. When we had a dip in 2017, it took 2 years for the market to come back. And then in the crash in the late 80s, early 90s, it took between 10 and 15 years, depending on the market you were in, for it to come back. And that was an extreme example, the norm being much tamer. So basically they're saying that, you know, they don't expect what happened in the 80s to happen again, but that they just wanted to use that as an example. And so what they have said is in typical markets that are localized. So again, you can't do a broad stroke across Canada, but in typical markets that are localized, it usually takes 2 to 3 years for the prices to bottom out, and then another 4 to 5 years for prices to fully recover. So that's what they typically find. And then the final thing is that they're saying don't expect it to be like the U.S. housing crisis of 2008, because there's been too many things that have been put into place to ensure that that doesn't happen. The financial system has spent years preparing for this sort of event. So basically they're saying virtually all mortgages in Canada are full recourse, keeping defaults low. Stress tests ensure buyers can pay between 4.75 and 5.25 mortgage rates without stretching. So basically what they're saying there is that, you know, we have introduced things throughout the years because they never want a financial crisis to happen again like that when it came to housing. And we introduced the stress test here in Canada to ensure that even if you bought a house with historically low interest rates, the stress test just made sure that if the interest rates went up, that you can still afford your payments. So that's what they're saying, that it's not going to be like 2008. We won't have that. And then the final thing that they're saying is that, you know, the bank sees fundamentals preventing real estate from getting too out of hand as well. Strong immigration and peak millennial demographics will prevent the floor from falling out. So, sort of. Affordability still needs to make sense for these buyers. So what they're saying is, yes, there's going to be a correction, but there's other fundamentals that are going to be in play that, you know, you'll never see a huge crash because you still have immigrations, you still have millennials that want to buy. Now, they are saying that the immigration and millennials will want affordability, so there has to be some sort of match there, but that's what's going to prevent it from dropping fully. So there will be buyers waiting, but prices need to make sense in the higher rate world. So that's how they end it. I'm going to summarize this, but if you have any questions, let me know, and I'll make sure that I link to this article in the video. So what does this mean for you? I would say a couple of things. Real estate is always a solid bet, especially if it's long term. So even if you bought at the height of the market, if you are going to stay in that property for a long time, then you'll be okay. Because, you know, even in our worst crash in the 80s, 15 years later, it came back. So if you are planning on staying in your property for a long time, Toronto's real estate market has always proven to be a solid investment. And me personally, I still believe in Toronto real estate when it's the right property and the right opportunity. We bought a property this year in 2022. We also bought a property in 2021. And we know even in this market right now that we can sell the property that we bought in 2022 with a few renovations and a quick fixes at a profit. But we got it at a significant discount, and we got it at a price that is more in line with 2020, 2019. And so it was finding the right opportunity in this marketplace. So that's it. I hope that makes sense. And if you have any questions, feel free to reach out, call, text, email, or WhatsApp, or even better, make an appointment directly with me. I love talking real estate and I'm always happy to help you out. My name is Connie Sarvanandan. Thanks for watching.